China's economy shows new signs of strain as factory output and retail sales hit one-year lows. China's economy has once again flashed warning signals as new data shows that both factory output and retail sales expanded at their slowest pace in more than a year, raising fresh concerns about the strength of the world's second-largest economy. According to October figures, industrial production grew only 4.9% year-on-year, falling short of expectations and marking the weakest performance since August 2024. Economists had forecast an increase of around 5.5%. But the latest numbers highlight a slowdown in manufacturing momentum across multiple sectors. At the same time, retail sales grew just 2.9%, a sharp indication that Chinese consumers remain cautious. This sluggish pace points to persistent weakness in domestic demand, despite government efforts to boost spending and restore confidence. A deeper look. What's driving the slowdown? China's economy is navigating a challenging landscape shaped by both global and domestic pressures. 1. Weak global demand. Global trade has softened as the U.S. and European economies cool down, reducing orders for Chinese goods. This has directly impacted China's factories, which rely heavily on export markets. 2. Domestic consumption remains fragile. Even though China has tried to shift from export-driven growth to a consumption-driven model, consumer confidence remains low. Households are holding back on spending due to uncertainty about jobs, income pressures, lingering concerns from the real estate downturn. 3. Property sector crisis. China's multi-year housing slowdown continues to drag on economic activity. Developers are struggling. Construction has weakened, and related industries, from cement to furniture, feeling the impact. 4. Need for stronger policy action. Economists argue that China must introduce deeper structural reforms to stimulate domestic demand. While Beijing has offered targeted support, the latest data suggests it is not enough to revive growth meaningfully. Why these numbers matter globally. A slowdown in China does not remain within its borders. It can trigger ripple effects across the world. Lower demand for global commodities like oil, coal, steel, and copper, disruptions in supply chains as factory activity weakens pressure on international markets, especially Asian economies linked to China's trade system. With China contributing a major share to global economic growth in the last 2 decades. The latest trends raise concerns about the stability of the global economy heading into 2026. What happens next? Beijing faces a difficult balancing act. To restore economic momentum, China will need to strengthen consumer confidence, provide relief to the struggling property sector, encourage private sector investment, support manufacturing and technological innovation if decisive action is not taken soon. Analysts warn that China's economic slowdown could deepen, affecting markets worldwide. Conclusion. The latest factory output and retail sales numbers provide a clear message. China's recovery is losing steam, and the country's shift toward domestic consumption is progressing slower than planned, with both global uncertainties and internal challenges mounting. The coming months will be crucial for policymakers seeking to stabilize and redirect the trajectory of the Chinese economy.